Welcome to GRE. I'm your host, Keith Weinhold. The world is about to end again. It's the economic disaster that never arrives. I'll break it down. Then you've been earning money and investing well all these years. How does it all go together? It can culminate in the 7-figure solution. It's about seeing your future today on Get Rich Education. What if I told you that one of America's strongest cash flow real estate markets is also becoming the new brains and brawn behind AI? That city is Memphis, believe it or not. And September 30th, we're going to show you why the smart money is paying attention now, along with an investing opportunity you won't want to miss. Join me, Terry Kerr, and Matthew Van Horn of Mid South Homebuyers, the largest turnkey company in Memphis with more than 6,000 homes under management, for a free live webinar, the likes of which I've never done before. We're going to look at what billions in new investment could mean for jobs, housing demand, neighborhood appreciation, and your portfolio. Everyone who attends live will also get exclusive access to the best deal terms Mid-South has ever offered. Reserve your free seat at getricheducation.com/Mid-South. Again, that's September 30th. Don't say we didn't tell you. Save your spot at getricheducation.com/Mid-South.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Kankakee, Illinois to Cherokee, Iowa, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, and the world is about to end. Even if you survive, your portfolio surely won't. Oh, geez. At least that's the impression you get from mass media and what I'll call the doom scroll industrial complex. Fear creates urgency, urgency attracts eyeballs, eyeballs attract ad dollars, and I guess that using a slogan like, everything will probably be fine, well, that's never been a great ratings strategy. Now, consider what has happened since 2020. Just this cheery little sequence. COVID, then Ukraine, Israel-Gaza, tariffs, and then the war in Iran. All that just since 2020? I mean, that right there sounds less like an economic timeline and more like a movie plot, or that the world is repeatedly spinning the wheel of misfortune. Yet after all of that, what is the result? Both stocks and residential real estate are near all-time highs. Apparently, the apocalypse has been postponed yet again, at least economically speaking. Now, let's zoom out and break down these threats and a few more, all just since 2020. Because 2020 is the year where, of course, you had the COVID-19 pandemic, economic shutdowns, the fastest major stock bear market in history, supply chain breakdown, you saw empty shelves, and there was unprecedented government intervention, from the Paycheck Protection Program to stimulus checks to mortgage loan forbearance. Then in 2021 and 2022, you had post-COVID inflation and supply shortages. Now, this was more of a result, not strictly geopolitical, but a major investment threat, and that led to aggressive interest rate hikes. From 2022 to the present, you have Russia's invasion of Ukraine. Energy and food shocks came from that. Sanctions, instability over in Europe, and really a heightened nuclear risk. In 2023, you had the U.S. regional banking crisis. Remember SVB? Yeah, Silicon Valley Bank, Signature Bank, First Republic. They raised fears of a financial contagion that would spread like faster than a secret in a small town. It actually made me buy some gold. From 2023 to the present, you have the Israel-Hamas war and this broad Middle East instability. Hezbollah attacks, Houthi attacks, Red Sea shipping disruptions. It's almost like a geopolitical group project. And then from 2025 to the present, you have renewed U.S. tariffs and a global trade war. And this year, you have the U.S.-Israeli war with Iran and the Strait of Hormuz disruption. That is the biggest current geopolitical investment threat because it combines all of these things: war, oil disruption, inflation, higher interest rates, and a recession risk. So it's a lot like this particularly unpleasant smoothie that's been blended together. All right, well, all of that is just an absurd amount of uncertainty and disruption only since 2020. And though major markets are at all-time highs in the face of this, well, let's acknowledge that some were hurt here, like apartment building owners vulnerable to interest rate resets, and certain commercial sectors like office. Even worse, let's be sensitive to the fact that COVID and wars have resulted in a real loss of life. GRE's enduring strategy of primarily owning long-term residential rentals with fixed-rate debt has been comparatively really resilient. In fact, these calamities, they probably made you better off from the inflation that it has spurred. More people work from home. Well, that means that they're consuming our product while higher inflation debased our debt and jacked up our property values and our rents. And, somehow every single generation thinks that their collection of crises is uniquely terrifying, and it is not. And what do I mean by this? Well, in the 1980s, people feared war with the Soviet Union, the Cold War. A global population explosion so bad that millions or billions of people would surely die from hunger. You had the AIDS crisis. You had a hole in the ozone layer. Well, all those things, virtually zero investors make decisions based on that stuff, an imminent Soviet attack or mass starvation from overpopulation. There is one thing that is 100% certain here, and that is that more shocks are coming. In case you don't want to sleep well, you can get worked up over the certainty of future calamities. Artificial intelligence is making cyber attacks faster and more scalable. AI has even created entirely novel viruses. A confrontation between China and Taiwan, that could create risk in the semiconductor space. A blockade that might disrupt the world's advanced chip supply, creating more inflation and more uncertainty. Here is what's changed, though. For what investors care about, you know what has changed with today's set of calamities versus those of the 1980s and earlier? Because there is something, and it's a big deal for investors. Here's what's changed. Recent history shows that the government does more to intervene during disasters. Stimulus checks, liquidity programs where they're printing trillions, bailouts, pushing interest rates down to almost zero, quantitative easing. How about a foreclosure moratorium? Anything. During COVID, it was a lot of these things, and it was the CARES Act, and it was a student loan payment pause. I mean, the Federal Reserve even set up emergency credit facilities. We now know that when the economic building catches fire, policymakers, they rarely stand around admiring the flames. They just flood the place with currency. So the best investors, they keep prudently building real estate portfolios in the face of risk, not the absence of risk, because the latter does not exist. This incessant government intervention, whether you agree with it or not, it gives you more safety cushions the next time that things fall apart, That's why what appears risky is still risky, but less so. So there is more incentive to take on prudent risk than I've ever seen. No politician wants America to fall apart under their watch. So increasingly, they'll just paper over the problem by printing, and then, therefore, the resultant inflation, the consequence of this, that can be dealt with under the next president's watch, not theirs. In fact, future calamities, they almost make you want to own scarce real assets that benefit from inflation, not a hedge, a benefit. Trying to time every war, election, banking crisis, tariff announcement, virus, and Fed decision, trying to time all of those things, that is usually ineffective. You either own more assets or you get left behind. And everything that's happened since 2020, that just underscores this. In fact, Berkshire Hathaway, the closely watched company that Warren Buffett ran for a long time, but he still has influence in, they recently began moving out of cash and into assets. They ended their long net selling stretch. In fact, in the latest quarter ended, they've now done the most buying that they've done since early 2022. They have jumped back in the game. It appears that Berkshire Hathaway got tired of sitting on the sidelines and seeing others make gains. And they're pretty bullish on housing too. They bought a home builder. The bottom line here is that shocks are going to keep arriving, and yet productive assets and well-financed residential real estate has repeatedly survived them and just continued appreciating. Don't wait for a risk-free world because you'll wait forever. When you evaluate all these calamities just since 2020, again, COVID, Ukraine, Israel, Gaza, tariffs, and war in Iran, and then you realize that both real estate and stocks are near all-time highs anyway, and the government keeps backstopping asset owners like never before, this is just a fresh angle on how much better off you are when you prudently own more inflation-benefiting assets sooner. I want to tell you about something called the seven-figure solution. You've been here listening to me weekly since 2014. You've been earning money. You've been investing well. And now you're going to see how it all goes together. It's about making sure that your real estate and your other assets appropriately fund your retirement in a way that gives you protection against market downturns, a tax-advantaged pool of liquidity, the death benefit of a life insurance policy, and actually introduces you to a new form of leverage all at the same time. Now, the liquidity here is key because this is where a 401k or IRA limit you. They have taxes and penalties if you want to use those funds early. This doesn't. But the seven-figure solution, it's not just for retirees. In fact, our own in-house investment coach, Naresh, uses something like this, and he is in his 30s. Let's discuss it, and then you'll see where I have an invitation for you where you can get involved. I'd like to welcome in a guest we last had on the show a few years ago. He's a frequent guest on popular shows, including our friends over at the Real Estate Guys radio show. And this guest has also been a terrestrial radio show host himself. He's a long-time real estate educator and an active investor just like you and I, so he speaks from experience and not a textbook. He's the creator of what we'll discuss today called the seven-figure solution. Welcome back to the show, Jared Garfield.
Keith, hey, it's great to be with you again. Thanks for having me.
It's so good. Now, you're with the Haven Bridge Group, and you help people, especially real estate investors, with what's called the seven-figure solution. Tell us about it.
Well, Haven Bridge, we did the name for that because people are really looking for a haven of safety. And the bridge is kind of what crosses the gaps that could kind of destroy your wealth. And it's the path to get there. So we want to take people on a path to safety. And the seven-figure solution is the idea that if you're going to be drawing out even 4% per year to not outlive your money, because people are living now to 85, 90, 95 years old. And so that means you can have 35 years in retirement. And with inflation and different things like that, you really have to have a lot bigger nest egg than what most people realize. So a seven-figure solution is how to get to more than $1 million liquid that you can draw on in a tax-advantaged manner for the rest of your life while also having living benefits. And we pull real estate in with it because we want people to have 10 or 15 or 20 rental properties by the time they're retired, that they 1031 exchange regularly so that they're always keeping tax advantages so that even in retirement, you have strong tax advantages. And ultimately, we think that when you're 65 or 70, you might want to go from 30 single family houses to 1031 exchange into one institutional asset that's a little bit less management intensive.
Okay, so this is a tax advantage vehicle that real estate investors can use during their investing career. And those tax advantages then really convert into something that you can use in retirement as well.
Yes, what it does is it's a vehicle that instead of saving the money from your cash flow from your rental properties in the bank, we say, well, why wouldn't you rather invest in something where it grows tax-free, number one, and then number two, you don't have the penalties like you would with a 401k where you get taxed and you get penalized 10% if you pull it out. It's liquid, usually about 80 to 90% liquid, so you can pull from it whenever you like, and you can use it for down payments to grow your real estate portfolio, but you can earn sometimes between 5 and even 7 or 8% in a tax advantage manner where you're not taxed on it, but you're earning a much higher return than if you put the cash flow into a bank.
All right, so you're building this tax advantage pool of capital that grows over time. And this is important to have some liquidity. You know, Jared, I've often talked to our audience about 3 to 5% of your portfolio value ought to be kept liquid. Maybe with a vehicle like this, you would want to put in more of that because real estate investors, we have expenses. So you have this liquidity to cover things like vacancies and major repairs, or perhaps you could even use this account for future down payments on additional investment properties. Is that how it's utilized?
Yeah, absolutely. And I did it partially this way because in my early 20s, I got up to where I had about 6 rentals. And at the time, I also owned a real estate brokerage and I was doing very well. I was making a 6-figure income and things. And what happened is I ended
Back when
up,
a 6-figure income was a big deal.
yeah, back in the early 2000s, it was a little bit better money. But the funny thing was I had 4 rental properties that all went vacant at the same exact time. And so now all of a sudden I was paying like $4,500 a month in mortgages, not counting the house I lived in, but I had to cover 4 mortgages on 4 of my rental properties all at the same time. And I hadn't saved the cash flow, so I didn't have a huge emergency fund. All my liquid capital went into down payments and into renovation money to rehab the properties. Okay. And so it put me in a real bind. And I was out driving a Volvo S80 around throwing 2 paper routes in the mornings and then going to my real estate brokerage after my paper routes to cover those rental properties. And so this was basically meant as a way to say, okay, this is a way that I have the liquidity. I'm getting a higher return, but now my tenants are not only buying me the houses, but they're also giving me a couple $1 million in life insurance, and they're wrapping my investment component or the cash value of that, the cash value part of the policy, they're wrapping that in a way that it grows tax-free. So it just accomplishes a lot of things. But the other thing that's a beautiful thing about it is there's a lot of things that we call living benefits.
All right, so you have the living benefits and the tax advantages. And I know how you have pointed out that this can save an investor tens of thousands of dollars in taxes per year and hundreds of thousands or more over time. Can you tell us more about that?
Yeah, because what happens is the money that goes in is growing tax-free, so you don't get taxed on any of the growth. But what we really like about it is, let's say that you're cash flowing $2,000 a month off your rental properties, and you're putting $2,000 a month into this policy. Usually after the first year, if you're max funding, 80 to 90% of that's liquid. So if you've got 24,000 sitting in there, you've got access to 89 to 90% of the money. So it's pretty liquid. But what happens is over a 20 or 30 year period, that money could turn into 3 or 400,000 a year that you can pull out in the form of policy loans. And by doing that, it's not taxed, and you can pull that out throughout your retirement tax free. So if you were paying 25% in taxes and you're pulling out 200 grand a year, that's $50,000 a year in retirement that you're saving in taxes. But that could be over a 20 or 30 year period. So over 20 years, that 50,000 could end up being a lot of money. I mean, 500,000 over 10 years, a million over 20. And so that means you don't have to accumulate as much. But a lot of our investors love it because they'll save it up with discipline. And then that way it's there if the furnace blows. So it makes your real estate safer, but it also becomes your down payment funds to expand your portfolio.
Okay, the seven-figure solution is the vehicle that we're talking about here. And what part of the IRS code, just briefly, is it that gives this tax advantage?
It's Internal Revenue Code Section 79 that allows it to grow tax-free. In the 1980s, doctors and a lot of very wealthy people were using this to the point that IRS changed the laws. They went and sued the insurance companies because doctors would go in and dump $2 million in, and they would buy a $2 million life insurance policy. So they were self-insured, which meant that they didn't have any cost of mortality on it. So they basically got all the benefits of the tax-free growth and the tax-free pullout. And the IRS said, wait a minute, we think you're doing tax evasion. So what they did is they came around and they said, we're not going to let you use this loophole anymore for the very wealthiest people to have this. So they came to a compromise. And the compromise was that if you wanted to put in 2 million, you had to maintain a corridor where there had to be a little bit higher amount of life insurance. So you might have to buy a $2.3 million policy, but then you could still dump, say, $2 million in and have all the tax advantages. It's a strategy that's been used for over 100 years by families like the Rockefellers and the Hunts and JP Morgan. The very wealthiest families have always used these strategies to grow and protect their wealth.
Okay, so it's a part of the tax code that allows cash value to accumulate within and be withdrawn from a life insurance policy tax-free.
Correct. And it gives you living benefits, which I alluded to a minute ago. And the living benefits are if you end up having to go through things like long-term care, disability, if you can't perform, certain functions for a certain period of time, chronic illness, critical illness, terminal illness. If any of those things happen to you, you can borrow against the policy and have access to money during those things that would normally decimate your wealth because you can actually access the death benefit in advance.
Now, I know a little about the 6 risks. Tell us about that.
Well, Keith, there are 6 risks that all investors face regularly. The first one is inflation erosion, and that means that your purchasing power often ends up leaking out of your balance, and the balance might look fine, but inflation can eat away at it. So even if you've raised a lot of money, if inflation means that you can buy half as much 5 or 10 years from now, then your wealth isn't as big as you thought. The second is the volatility setback, and that's sequence of return risk. That means that if you retire on a bad year where things are really bad and the stock market drops, you could end up using your money at a time where it really weakens your wealth because it may have dropped by 50%. So if you had $1 million, now you have $500,000, and you're spending $100,000 a year. At the end of year one, you might only have $400,000 left. So sequence of return risks from volatility setback. Tax drain, that's just the compounding cost of an uncoordinated tax picture can really be a problem. And then the next one is liquidity. If you don't have liquidity and you've locked up all your money and you can't access it until you're 59 and a half without significant taxation and 10% penalties, the liquidity lock is a problem. There's the longevity paradox. What happens if you outlive your money? So living longer is a benefit, but it exposes you to where you might not have enough money to live on in your latter years. The last 2 are care avalanche, and that is if an unexpected health event happens at the wrong time, it could really destroy your wealth because medical costs have spiraled out of control. And then the last one is the line to land, and that's only one of the 6 that's really about growth.
Right. Only one of the 6 of those was about growth. I can't stand the longevity paradox. Yeah, we think we all want to live a long time, but then it's more difficult to fund living a long time. And if you outlive everybody, nobody shows up at your funeral either. The longevity paradox, one of the 6 risks that the 7-figure solution can really help you with. Now, tell us more about funding it so you can get a good cash value balance in there. I know that one way you do it is actually with short-term rentals instead of a paycheck.
We love short-term rentals, especially for our highest net worth clients, because the reason is the bonus depreciation of the big, beautiful bill.
Oh, right.
You could take up to like $150,000 or even $200,000 in year one. They take that depreciation that they used to spread out over a whole lot of years, and they make it to where if you get with your CPA and you analyze your short-term rental, you could potentially take all of the furnishings, all of the artwork, all of the dishes and things that are in the property. Sometimes they'll let you take components like the appliances, the air conditioning unit, the furnace, and they'll let you take it all in year one instead of having to line item it and spread it out over, 27 and a half years. So what this means is if you have a short-term rental, then you might get like 150 to 200,000 tax break in the first year on the right property. But it's better than that because instead of having to have like 750 hours to hit full-time real estate professional status, it cuts the hours that you have to have significantly down. I think it's more like 150 hours or something like that, or 300. It's like half the hours. And so you can hit the benefits of taking unlimited passive loss much easier if you have a couple of short-term rentals.
You're listening to Get Rich Education. We're talking with Jared Garfield about the 7-figure solution, something that takes some time to understand, but it can give you a tax advantage pool of capital that grows over time. And it also creates this overall tailwind, not just during your investor life, but then it provides tax advantaged retirement income at the same time. More on this when we come back. You're listening to Get Rich Education. I'm your host, Keith Weinhold. What if you got your mortgage loans the same place I get mine? You sure can at Ridge Lending Group, NMLS 42056. They provided GRE listeners with more loans than anyone because Ridge specializes in investment property. They'll help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat directly with President Chaley Ridge. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. Let me ask you something. If you've worked hard to build wealth, is your money positioned to actually support your goals? A lot of accredited investors leave capital sitting in cash because it feels safe, but inflation and missed income opportunities can quietly erode its value. Freedom Family Investments offers Freedom Notes for investors seeking structured income backed by real estate. It's a straightforward approach built on real assets, not speculation. And full disclosure, I'm an investor myself. What I like is that their team walks you through how it all works so you can decide if it aligns with your portfolio and income goals. Every investment carries risk and nothing is guaranteed, but with a track record of consistent on-time investor payouts, they've built real credibility. Go to freedomfamilyinvestments.com to book a clarity call or text FAMILY to 66866. That's FAMILY to 66866.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. We're talking about the 7-figure solution with Jared Garfield, something that can be of particular benefit to real estate investors, both during your investing career and then once you're in retirement as well. And this can take the form of either an index universal life policy or a whole life policy. There are a lot of wrong ways to do this and wrong things to get into. We're talking about the right way. Part of that is funding it as best you can. Can you tell us more about that?
Well, there's a lot of different ways to fund it. A lot of our clients will come in. We have some people who will use rollovers if they're nearing the end of retirement. Some people will roll over a 401k into a cash value life insurance policy because they can do it over a 5 or 7 year period. and they pay the taxes when they roll it over. So their taxes go up a little bit for 5 or 7 years of retirement. But then what happens is that means that during their retirement, they're not taxed on the income all the way through retirement. So that can save really significantly. But a lot of our clients will do a flip and dump 40 or 50,000 a year in by just saying, I'm going to do one flip a year and use that to fund the whole thing. Or they'll take the cash flow and dump the cash flow into here instead of the bank, just so that they get the living benefits and they get the much higher return with still 80 to 90% liquidity. So could be cash flow from rentals, could be money from a flip, or sometimes some of these short-term rentals can make $20,000 to $30,000 a year. And if you get a $100,000 tax break, you have more money that's not going to Uncle Sam. And then because that's your discretionary income now, because of the tax break, you could use that money for down payments to grow your portfolio or to do a flip.
Now, Jared, I sort of think of the cash value that you're accumulating in this policy as safe money that grows at a slow to moderate steady rate, but if it rarely or ever loses value. Can you tell us more about that and the rate of return expected in the policy?
Yeah, absolutely. With the IULs, it's going to depend a little bit upon the carriers and stuff like that, and whether you go with a mutual company and stuff like that. It can vary, but a lot of times people are going with things that are what we call indexed. So you can actually index it to the S&P 500 if you think that we're going to have a bull market and the market's going to really go up strongly. You can index it to the market, and sometimes they'll have a participation rate where they'll say, okay, you can participate up to 12%. So if the stock market does 17%, the most you can make is 12%. So you're giving up a little bit of upside, but that's still not nothing. I mean, that's not 3 or 4%. You can still make, 10 or 12% that year, but you're giving up the part above the participation rate. And the reason that you do that is if the market tanks and drops by 30 or 40%, the worst you can do is 0% return. Zero is my hero because you didn't lose anything. So if you had a $500,000 sitting there, you don't go down to 250 and then wait 8 years to get back to break even. Instead, you're still at $500,000. And if the market goes up next year by 20% and you had a 10% cap, then your $500,000, is now at 550,000 when everybody else, if it went up by 10%, they're at half the amount that they had.
You have a story or example of how you've helped somebody with this? Because I know a lot of investors that are passionate about utilizing the cash value inside an insurance policy. Tell us.
Well, I've got one friend who's a developer, and he did like a $5 million policy. And every time he flipped a subdivision or flip a house,
And let's back up. Does a $5 million policy mean that's the death benefit?
Yeah, that's the death benefit. Thanks for catching that. That's the death benefit, but that also has a correlation to how much money you can dump into it. So if you have a $5 million policy, you can dump a lot more money in for the tax-free growth. And the quicker you hit that death benefit amount, at that point, you're self-insured. And so at that point, you really don't have cost of insurance on administering the policy hardly at all. And so at that point, when you're what we call self-insured, the return on the investment becomes a lot better. But this particular developer was able to use this policy because he had so much cash value in. And if he sold a house, he'd take 40,000. If he sold 10 a year, he might take, 400,000 and dump it into this policy. And so it made him bankable. And he was able to use the money to go out and do new subdivision developments because the bank would actually use the policy as the collateral to be able to give him loans at much lower interest rates.
That's valuable. Tell us about that. I don't want to use the wrong words here, but then effectively, with this example, are you borrowing against the funds in the policy, so therefore you can get those dollars working for you somewhere else, all while simultaneously the cash value continues to compound and grow, sort of another form of leverage?
Correct. What they basically do is they basically freeze part of the amount and say, okay, we're using this as the collateral and stuff like that to be able to do the loan. But if it grows and makes 7%, you're still making the money off of the money that's sitting in there. It's just collateralized as part of the loan. And some people will even use it to go buy a car. Like instead of buying a car and getting a bank loan and paying 7% to the bank, they might borrow money out, go pay cash for the car from the life insurance policy loan and pay 2% instead of 7%, but they're paying it to themselves. And as long as they're paying the interest to themselves, if the money that they borrow out could potentially still earn the same money and earn 7%, even though you had borrowed it out. So it's doing two things for you at the same time, as long as you're paying that loan interest. And that depends on the option that you take when you do your loan.
We love leverage around here. Leverage trumps compound interest in so many ways. Oh, I'm really glad that you told us some more about that. Using the funds in more than one way at the same time. Tell us more about what it costs for the investor, the costs of setting this up, and then what some of those trade-offs are, Jared.
Well, that really depends on the individual. I mean, everybody has to sit down and be able to decide what is acceptable for them. A lot of times people will want to max fund the 401k that they're doing, at least just to the amount that's matched. But then after that, this could be a great place. Instead of putting a whole bunch more money into a 401k, some people will elect to say, I'm going to put the matching portion into my 401k, but then I'm going to take my cash flow from my real estate and money that I could have contributed to other alternatives and put it into this because I want the liquidity. I want to be able to leverage this money and pull it out without any restrictions, that as long as I can pull out 80 to 90%, I could go buy a car wash, or I could invest in a business, or I could, do whatever I wanted to. I could loan it to my kids for their college and make them pay me loans back to my policy. There gives you a lot of flexibility to do it. But the thing that we love about it is we'll do what's called an illustration, and it may end up, if you start at the right time, it could be a 6-figure passive income stream at retirement. And then if you have the real estate, because this helped you grow your portfolio, where without doing the strategy, you might have ended up with, say, 10 properties, we might be able to get you to 20 or 30 properties working together as a team with your real estate coaches and stuff like that. Then we can potentially grow your real estate portfolio. And what we want to do is 1031 exchange every 7 to 8 years. I don't believe in holding properties for 30 years. I believe in exchanging them every 7 to 8 years, because when the tax benefits have been used up, if you exchange to twice the size portfolio, you have better appreciation on a portfolio worth twice as much. But that new value, you still get the depreciation advantages, where the old value that was half, the depreciation's used up. So you're getting new depreciation on the higher value assets. And then our goal would be that by the time you don't want to be involved in managing the property managers, that at some point you're going to have a 200 unit apartment complex with on-site management. And at that point, you don't have any financial worries really, because you're 1031 exchanging into those apartment complexes, but you have so much equity that you're still maintaining depreciation during your retirement years, when most people who have lesser plans don't have the tax advantages.
I love that you said so much of that. And to you, the listener, Jared is licensed to do this, and our own in-house investment coach, you mentioned coaching, Naresh, has the proper licensing as well to holistically help integrate this into your investor life. And for example, yes, we are rarely of the mindset that you would hold a property for all 30 years, because after 7 to 10 years, your leverage ratio gets worn down. And then additionally, if you're buying turnkey properties, oftentimes that's when CapEx expenditures start to enter into the picture. So yes, oftentimes we do these 7 to 10 year holds.
I love that. Yeah, that's a really, really good strategy. And it always makes it to where you can grow so much bigger portfolio by not being taxed through that exchange. And, believe it or not, there's actually even ways when you have extra cash boot, they do allow, if you notify them in advance, sometimes you can take some of the cash boot on the exchange and roll it into some of the products that we utilize.
For more specifics, I know you said it's based on one's individual situation, but how much does it cost to set up a policy? And then are there any ongoing maintenance fees? Can you give us more specifics there?
So there's small fees to administer the policy, because you have people who are trading and doing different things and working within the policy for the funds. But usually you can set policies up as low as $100 or even $200 a month. We don't usually recommend that, because you want to max fund it. Usually when you're doing these strategies, if you're just doing $100 or $200 a month, you're basically buying life insurance, but you're missing a lot of the benefits, because what you want to do is to be able to max fund it. So what we like people to do is get as minimum life insurance. That's not in our advantage, because we get paid based on the premium of the amount of life insurance you get, but you get the smallest amount of life insurance for the amount that you can max fund. I would much rather have somebody get a $500 a month policy that, let's say, they could put, $1,000 a month in or something like that, than to have somebody get a $1,000 a month policy where they're paying the $1,000 a month, but they can't max fund it. Because by max funding it, you're maximizing the growth component of the cash value. And so it depends on how much you want, but you can go anywhere from $100 or $200 a month to, we have clients that will dump $20,000 a month in because they really want to shield as much money as they can from tax growth.
Tell us more about who the seven-figure solution is for and who it's not for.
Well, if you're living month to month and you don't have discretionary income, it's probably not a good solution. In that situation, you probably want to get term insurance and just make sure that you cover catastrophic things. But if you've got discretionary income and you've got an extra $400 to $500 a month that you could use to max fund, we figure most people need life insurance anyway. And the way that we teach it, when you mix it with real estate, rather than pulling it from your monthly budget, doesn't it make a lot more sense to let your tenants buy the houses for you, but also pay for a $500,000 or $1 million life insurance policy for you, where the tenants are covering the savings for anything that happens at the property with CapEx or vacancy or damage, and at the same time covering life insurance and potentially a six-figure passive income that's tax advantaged at retirement. So I pull the money out from other assets and let the assets cover this asset.
Oh, well, Jared, this has been great. Before I ask you if you have any last things to tell the audience about the seven-figure solution, I invite you, the audience, to join us. It's going to be Jared and our own in-house investment coach, Naresh, bringing you a live online event that you can join from the comfort of your own home next Thursday, the 27th at 8 p.m. Eastern. You can register now. It's free at grewebinars.com, because there are a lot of moving parts, and it does take some time to wrap your head around this, benefiting from the cash value of an insurance policy. And this way, you can have a Q&A and you can get answers in real time at this event. It's called The Seven-Figure Solution: Build Wealth, Reduce Risk, and Create Tax-Advantaged Retirement Income through Real Estate. Again, it is next Thursday, the 27th at 8 p.m. Eastern. You probably have generated some questions inside your head while you're listening to this, and you can sure have them answered there, as you're going to learn a whole lot more about it next Thursday. This could help a lot of people. Jared, do you have any last thoughts?
I think the only other thing is that we like to work with a team. We like to work with your CPA. We like to work with your real estate investment coach. I used to be a coach and trainer for Robert Kiyosaki, who wrote Rich Dad, Poor Dad, and he always talked about power teams. And so we want to be able to be a part of your power team and work with your other advisors to help you implement something. We're not here to give you tax advice. We want you to be able to work with your investment advisors and your CPAs and just be a part of the team. But I would point out that over my career, I've owned hundreds and hundreds of single-family cash flow rentals, duplexes, fourplexes, apartment complexes. I've done some land development, and I implement these strategies myself. I had 17 Airbnbs. And so these are the strategies that I implemented as a full-time real estate professional. I felt like that this strategy of having a seven-figure solution could help you to avoid some of the pitfalls that I experienced in my 20s.
So much all comes together for one pretty comprehensive solution. It's the intersection of growing your portfolio, getting tax advantages, and having the death benefits of insurance and more, all coming together next Thursday so that you can learn more. Jared, it's been great having you back on the show.
Thanks, Keith. Always glad to join you.
Integrate the seven-figure solution the GRE way, where we have this conscientiousness about leverage and cash flow. In this case, it's how to prudently leverage a life insurance policy. When it's time to tap your cash value, you take what is a policy loan, not a withdrawal, because you're borrowing against your cash value, hence using the funds in more than one place, and the IRS does not tax loan proceeds. This reminds me of a billionaire and how they borrow against the value of their stock. That way they don't have to sell their assets. This is similar to what you can do with this. Another thing is that, real estate investors are not used to a volatile ride because our asset values stay stable. You heard Jared mention the acronym IUL there. That's an Indexed Universal Life Policy. It's a real benefit that, say you tie yours to the S&P 500. Well, that index was down 18% in 2022, and that your cash value can have an upside ceiling and loss protection on the downside, an option that you'll care more about as you get toward retirement. In 2008, the S&P was down 37%. So the math is cruel on value losses. In fact, it's even worse than it sounds, because if you're down 30%, then you need a 43% gain just to get back to even. That is just math. There are some mistakes to avoid here, and you don't just want to set up your seven-figure solution off of a website. And it is based on products that you might have heard of from companies like Nationwide and Mass Mutual. I strongly encourage you, learn more, see how it all goes together, learn how the seven-figure solution compares to other vehicles like a Roth IRA, 401k, 721 exchange, and 1031 exchange. This is very much about seeing your future. You've been listening to me here every week for almost 12 years, earning money from your day job, building your real estate portfolio, either from our investment coaching or on your own. This is how it all goes together. Next week with Jared and GRE investment coach Naresh. By attending live, you can have your questions answered in real time. One last time, you can sign up for the event for next Thursday, the 27th at 8 p.m. Eastern, 5 p.m. Pacific. Learn about something that's potentially really valuable to you, the seven-figure solution, at grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.